Day 5, understanding risk management and stock trading. Let's get into it. Risk management and stock trading. Risk management is the practice of identifying, analyzing, and controlling the risks associated with trading stocks. The goal is to minimize losses and protect your capital while maximizing potential gains. It involves setting limits on the amount of capital you're willing to risk, deciding on trade sizes, and using strategies to manage potential downside risk. Okay, so analyzing and controlling the risk associated with trading stocks. Of course, like I said, there's always a risk that you can lose your money when you are trading. There is a risk you can lose your money. There is a risk you can lose your money. There is a risk you can lose your money. So we have to figure out how to manage risk. And more important than trading strategies, more important than the hot stock, more important than the secret news, the most important thing in trading is risk management. When you learn risk management, trading becomes fun. To keep it 100 with you. Risk management is low key for me one of the most that was the most fun part to figure out about trading. Because you know, once you master risk management, it's no longer a gamble. You know, I can make money every time I press this button. There's opportunity I can make a boatload of money compared to when I'm losing, which means overall I'm gonna make more money. Which means that if I know I can guarantee myself that I will make money, I can put a boatload of money in here and know that that boatload will flip to a boatload more. So risk management is the most important, not one of. It is the most important. I need y'all to understand and understand risk management. It involves setting limits on the amount of capital you're willing to risk. We're gonna set limits. Like we say, we only looking to risk 1 or 2% unless the strategy is different, and I hope you tested that out, etc. Right? Deciding on trade sizes, like we said, depending on how much we want to risk, and using strategies to manage potential downside risk. Which, like I said, I like to keep a tight stop because if I'm wrong, if it goes below my stop loss, how I like to play it, how I like to play stocks, usually I'm wrong if it hit it. And if not, it's a short loss, small loss. I'll get right back in on the next strong candle, so I'm not tripping. And like I showed y'all, we don't want that many entry signals. So if I'm only getting 2 entry signals every time if I'm only getting about 2 entry signals before my trade run off to the sunset, then I'm only going to usually really lose one. Usually I'm probably going to win that one trade, or I'm not going to only lose that one trade and then get a super good return. So as long as I'm not getting 50 false signals, I'm straight. If I'm getting 50 false signals at a 1 to 2 risk to reward ratio, I'm hit stick. I'm hit stick all the way. I'm going straight down under deep. You know what I'm saying? But if I'm getting only one false signal, and really just because my tight stop and I'm not trying to risk that much, I'm golden, man. I'm golden. It's beautiful. You know? Setting risk tolerance. Risk tolerance is the amount of loss you're willing to tolerate in pursuit of your trading goals. So that's just how much you're willing to lose. Can you, if you lose $100, will that hurt you? We be like, dang, I need that 100. Okay, then you shouldn't be trading with 100. Maybe you only need to be trading with 10. If that 10 hurt, you need to be trading with one. And I mean, if you can, and at that point, the one, yeah, you might as well just, you gotta go stack up at that point. You gotta get to the point to where when you lose, whatever you're willing to lose, when it doesn't hurt you, you stick to that number. And whenever you're ready to lose more, is when you can make more. It's that simple. It definitely varies from person to person, and it's definitely based on your financial situation, experience level, etc., and emotional comfort with the market. You got to be very emotionally disciplined. You cannot let your emotions get out of whack. You hit stick. Now that's why I don't like discretionary trading, because discretionary trading is person based and it's not rule based. And I like algorithms. I like systematic trading. So I don't like discretionary. That's why I like super. It needs to be this number at this exact point, and this is the reason why every single time. I don't like. I mean, well, it looks a little like this, but no, the sun align, and no, we're not trading like that at all. I'm gonna be emotional. I'm gonna emotionally trade like that every single time. I need a systematic algorithm. I need to be AI straight up when I'm trading. That's it. A general rule for beginners is to risk no more than 1 or 2%. Of course, we know that on a single trade. This helps to show that a few losses don't wipe out your capital. So if you got $1 million account and you put the whole $1 million on a trade and you lose your whole $1 million, you might not ever look at a stock chart ever again. So we need to make sure we be smart on risking our money the right way. All right, next slide. Using stop loss orders, we talked about this. A stop loss order automatically closes your trade when the price reaches a specific level, limiting your losses. For example, if you buy a stock at $100, you might set a stop loss at $90 to limit your loss to 10%. Trailing stop losses adjust automatically with the price movement to lock in profits as the stock rises, but still limit losses in the price drop. Still limit losses if the price drop. So trailing stops are actually something I use. I don't use trailing stops within my brokerage, which you can set a trailing stop in your brokerage. I don't use it like that because I don't even want the broker trying to play shady games with my money. We don't got time for that. So I'm eyeballing. I love the charts. I can watch the charts like it's a cartoon. I can watch charts like it's your favorite show. I can watch charts and eat cereal. You know what I'm saying? So I'm gonna be looking at my charts. I don't need the broker to look at them for me. You feel me? So I'm gonna trail my own stops on the chart and let it go. But that's pretty much trailing stops. Simple. Position sizing. Position sizing refers to how much capital you allocate to each trade. It's one of the most important aspects of risk management. Like I said, risk management is one of the most important aspects of trading. You dig? Position sizing. So, say for instance, we're looking to risk 2%, right? Position sizing is this. All right, I have $100 account. I might use a 10% position size, so I might use $10 in that trade, but I'm only looking to risk $2 of that $10 because that's 2% of my whole account. So I'm gonna break it down because it might confuse you a little bit. If I got a $100 account and I'm looking to risk 1 to 2% on the trade, like I told y'all, that's fine. We're looking to risk $2, but I might only use $10 in that trade. So I'm gonna use $10 to I can use $10 to potentially make another $10. But I only want to risk $2, so that's like what, a 1 to 5 risk to reward. That's basically what I'm doing. That's my one. I got a 1 to 5.5 risk to reward. Every day play out the right way, I got a 1 to 5.5, but I'm taking profits all the way through it. So yeah, that's one. I got a 1 to 5.5. That's my set in stone number. It's just that's the way I trade, and that's beautiful. But we risk no more than 2% of your total account value. Like we said, we know that. So that just keep that in mind. Position sizing and actual risk to reward is kind of different. They're slightly different, but they're interconnected. So let's let y'all know that. Or yeah, intra-connected, I should say. Okay, risk to reward ratio. The risk to reward ratio helps determine whether your potential reward. So basically, we touched on this, but just a little bit more in depth. For example, if you're willing to risk $100 on a trade, but you expect a potential profit of $300, your risk to reward would be 1 to 3. Same thing. If we're looking to risk 1,000 to make 3,000, our risk to reward is 1 to 3. If we're looking to risk 1 million to make 10 million, we have a 1 to 10 risk to reward ratio, right? The higher, of course, the better, right? So that's pretty much it. Usually the lowest you want to go is a 1 to 2, but we don't even want to do a 1 to 2. If we can get a 1 to 10, a 1 to 5, a 1 to 5, a 1 to 10. Usually for day trading, you really want to do a 1 to 5. You just gotta, it's a way, just no less than a 1 to 2 for sure. No less than a 1 to 2, and you gotta have a good win percentage, right? So, for instance, if you have a 1 to 2 risk reward, you have to at least be winning like 60%. So you gotta win 6 out of 10 of your trades. Now, starting off, I don't know if you could be able to win 6 to 10 out of your trades because you probably don't even know what a candlestick is. You know what I'm saying? Now, a 1 to 3, you only have to win like I think 40%. But if you got a 70% win rate and you're risking 1 to 3, dog, you in a real good position. You printing money. You printing money for real. Get to the next slide. Is that it? That's it. All right. See you on the next one. Y'all peace out. Hope y'all got some game out of this one.